In today's video, we're going to be ranking the best and the worst property investing strategies on a tier list. I'm going to be ranking them from S tier all the way down to F for a fail. And we're going to be unpacking some of the secrets as to how you can use these property investing strategies in a certain order to maximize your capital growth and your cash flow as you build out your property portfolio. Now, my name's Luke and I talk all things real estate, renovating and financial freedom on the channel. Head over to purposeproperty.com.au if you're looking for a Brisbane buyer's agent. The first item on our tier list, we're going to start with a bread and butter, an everyday Australian strategy, which is the buy and hold. A really exciting strategy. Never heard of it before, I'm sure. And so what I'm going to do is unpack buy and hold for you. What you do is you buy a house and then you hold it for a very long period of time. I'm going to give this a B tier listing. So it's not S or A. I think buy and hold is a great strategy overall. So I'm putting it at B. The reason buy and hold is not an S or an A tier strategy is it's too basic. It's pretty boring. Yes, it's a tried and true Australian property wealth creation strategy. You save a deposit, you buy a house, you sit on the house, you rent it out for a long period of time. The market goes up, the rents creep up over time, and you're able to create some wealth. It is a strategy that does work. You do need to be looking areas primed for capital growth over that short, mid, and long term. It's not a way you can fast track your journey, so that's why it's sitting at B tier for me. The next property investment strategy is property flipping, or the fix and flip. I've done this recently and I've been told in the YouTube comments that I did it wrong and have no idea about fixing and flipping homes. It was our first flip. We did make a small profit, not as much profit as we would like. We made $15,000 and we would like to have made 50 grand. If you want to click that video and go watch that renovation series, it's out there somewhere on YouTube, or you can click a card over here. But from the fix and flip, I'm going to give it a D ranking. The reason it's not terrible is it does work for some people. I think if you do really high-end renos, or you're a builder or you're a tradie, then it can be a great way for you to fast track your wealth, especially if you do it as your own home when you're fixing and flipping, so you don't have any capital gains tax. But for me, it also disrupts your lifestyle significantly. It's a massive amount of work and outlay of cash as well. So that's why it sits in D tier for me. There's too much upfront work involved. You don't get the long-term benefits of that property either. So it's not really an investing strategy. It's more of an active wealth creation strategy. So it's far more short term than I would like. So that's why flipping for me is sitting as a D tier. So the next one on our list is similar to flipping, but it's called the BRRRR strategy, or the buy, renovate, refinance, repeat strategy. Now I'm giving this one a massive S tier. Going from flipping at a D tier to an S tier on a BRRRR strategy, there's only a little bit of a difference, and that's you're taking a long-term approach. You still need to do a renovation, a cosmetic renovation to manufacture value. The reason I love this strategy is almost anyone can do it. You can do the research, you can do some DIY, you can outsource the trades, you can buy a property, you can add value through cosmetic renovations, and you can refinance to go again as long as you have the serviceability. Using the BRRRR strategy was the reason Emily and I are where I am today, or where we are today as a couple. It's because we were able to buy our properties, renovate them, refinance, and repeat the process until we built up a capital base. We were able to refinance at one point over $700,000 from CBA, Australia's biggest bank, and then go out and buy a unit block for some more cash flow play. So the BRRRR, or the buy, renovate, refinance, repeat strategy for me sits way up there at S tier. It ticks all the boxes. It's straightforward. So many people can get into this strategy if they're willing to do the hard work. And so that's why it sits at the top of my list so far. Number 4 is another strategy that Emily and I have used throughout our property investing journey, and this is house hacking. It's where you rent out separate bedrooms and you have essentially a bunch of roommates that pay your mortgage. When Emily and I bought our very first property, which unfortunately isn't a reno series here on YouTube, but we bought that home with the view to renovate it and do the BRRRR strategy, but also we house hacked. We lived downstairs, we rented out some rooms upstairs, and I'm going to give house hacking a C tier listing. The reason it's C tier is it's quite disruptive to your lifestyle. Obviously, you need to have housemates and you need to collect rent from them, you need to pay bills, and it also affects your living and lifestyle conditions. So it's in your own home, and although you get the financial benefits, you do have to sacrifice by living with other people. Through our experience as a married couple, I know it's pretty weird to do, but it's what we had to do to fast track our journey. So we lived downstairs in a flat and rented out the upstairs space. We were able to build in a kitchenette downstairs downstairs, upgrade the bathroom and do some renovations while renting out the rooms upstairs, and that really supercharged our property investing journey. Our initial savings was only about $66,000. So to be able to house hack and use the burst strategy together really fast-tracked our property portfolio. The next one on the list as far as property investing strategy goes is Airbnb or short-term rentals. I'm giving this a B ranking. The reason it's a B is I think it can be highly effective. Using Airbnb or Booking.com can be a great way for you to boost your cash flows. But when you start using an Airbnb or you start doing short-term rentals, it can also hurt your serviceability. So you need to be aware of how running a short-term rental business essentially impacts your overall property portfolio and how it impacts your future financing. I know, for example, if you run an Airbnb, you may need to get a long-term rental appraisal for you to be able to draw equity or to be able to increase your debt and keep growing your property portfolio. The reason it's a B tier is it does generate some significant cash flows if you run the business yourself. There are some crazy management fees out there, 10 to 15% for a manager to manage, or even 20% for a manager to manage the Airbnb for you. But if you're willing to do it yourself, create some active income, obviously you're getting the maximum benefit as far as cash flow goes on your property and still getting the benefits of long-term growth. So I don't mind short-term rentals, B tier. Now we're moving into an interesting one. This is probably a big topic. It's commercial property. Now, I'm a residential property buyer's agent. We don't buy commercial property here in Southeast Queensland. That's a whole different ballgame. And I actually think commercial property is an A-tier investment. The reason I think so many people struggle with commercial property is you need significant capital to get into commercial assets. Whether you're buying retail, industrial, office spaces, hotels, there's so many variables when it comes to buying a commercial property, and you've also got to think about those lease periods. Obviously, a lot of the maintenance and uptake is handled by the tenant. So there's a lot of factors when it comes to commercial property, but I do think it is an A-tier asset because of the net returns you get, and you still get some capital growth. The big thing that stops people breaking into commercial property is capital. It's capital intensive. You need 30% deposits, and most of the good assets are going to be $2 million plus. All the commercial assets sitting between $300K to $2 million. Yes, they might have higher cash flows. Yes, you might get some good net rental yields out of them, but you just got to be aware of those risk factors. In my opinion, the really great commercial assets are the much larger assets, the $2, $3, $5 million assets up to the $10, $50 million assets that some of the super funds would buy. So you just got to be aware of that. I would love to buy a shopping center down the track and own the entire shopping center, but that could cost you $10, $30, $50 million. So there are going to be some good commercial assets out there. Industrial's been very popular. I'm giving it an A tier list because I think it can be some people's way to generate cash flow towards the end of their property portfolio. The way Emily and I have structured our own property portfolio journey is to buy our residential capital growth properties first. We wanted to build out the asset base to around that $3.5 million mark. And then once we did that, we moved the goalposts, we kept going, and we moved that to a $5 million mark, which we hit only 18 months later. So at this point in time, we've got a property portfolio sitting around that $5 to $6 million, depending on the valuations. And so for Emily and I, longer term, we might look at some commercial assets. In particular, a motel is the one I'm looking at buying for, say, $2 to $3 million. So I think commercial assets can be great for property investors. It's obviously not something that I specialize in, but I definitely see it as a great investment vehicle if you can find the right asset. Let's close out with some absolute clangers. Let's talk about subdivisions. I think these are C tier. Again, I think they're very capital intensive. You need to have a lot of knowledge and build a lot of networks. You need to do the civil works on a property if you're doing a land subdivision. There's a lot of work involved. If you can overcome all those hurdles and you have the capital to do it, great, then you're able to progress from there. But for most everyday Australians, it's going to be a very hard task to do a subdivision and to actually make a significant profit. It does work for some people who have experience, and this is something you build. It's like a muscle. You've got to, do it lots of times to build that muscle of developing or subdividing and creating value through those developments. And so that's why I'm ranking it right in the middle at around that C tier. Now we've got crowdfunding and property syndicates, and this for me is a fail. It's F tier. You have no control, you have no leverage, you don't own the asset that they typically hold. They typically hold it through a trust or a company structure. You have to also understand the liquidity of what you're holding, those stocks or units that you actually hold in that syndicate or trust or REIT. So in my opinion, you lose the power of leverage. You also need to understand the liquidity of the stock or share that you hold in that real estate investment trust or property syndicate or crowd-funded source. And so in my opinion, when you don't have your name on the title, whether it's in a company, trust, or your personal name, if your name is not on the title, in my opinion, it's not a great idea. So F tier. Now, another one that's quite popular in the property investing space is joint ventures. This to me is a D tier. Joint ventures are better than the syndicates. They're better than those REITs because you do get with a joint venture some typically leverage in your own ability to control that asset as well. But it's about picking the right partner. If you've got a great investing partner, if you're able to manage the capital and you're able to manage the relationships really well, then I'm sure joint ventures can work for some people fantastically. I've even been approached myself by plenty of people who want to do a joint venture. But for me, I'd like to keep things simple. And joint ventures don't keep things simple. You need to do lots of contract work. You need to understand that individual and their decision making and what they want to do. You need to plan for worst case scenarios like you do in all situations. But adding a joint venture in adds complexity. And so for me, that's why it's a D tier. Now, this is a bonus, and this is our stacker strategy. And this is something that Emily and I have used, and I alluded to a little bit earlier in this video. The stacker strategy is where you use multiple of these investment strategies on one property and create significant wealth. For example, if you buy an ugly duckling property and you're 23, 25 years old and you're willing to live in the home and house hack, you can do a buy, renovate, refinance, repeat strategy. You can then do house hacking. If you then buy a block that's on 800 or 1,000 square meters, you can have development potential, whether you want to subdivide or you want to add a granny flat down the track. So if you want to use the stacker strategy, you can essentially use 3 to 4 of these strategies in one purchase. And this will really supercharge your property investing journey. That's what exactly Emily and I did throughout our investing journey. We bought a property, so we used the burst strategy first. We house hacked. We were then looking at a buy and hold strategy once we put those two things in place and we moved out of the home. And for some of our other properties, we've bought a property with some cosmetic value add potential and future subdivision or development potential with dual street frontage. Or we can add a granny flat on a property here or there once we've done a cosmetic reno. So if you can stack these strategies together, that's where I think you can get an S tier outcome throughout your property investing journey. Of course, none of this comes cheap or for free. It's a lot of hard work. You still need to be able to do your day job income. I'm sure you're watching these YouTube videos. Hopefully you're not watching these at work, but if you are, tell your boss that you like the channel and you want to like and subscribe and that kind of stuff. So you do need to do your research. You do need to understand the strategies and ways property investors can get ahead. But in my opinion, if you can use your skills and income and look at these strategies and apply them to your own situation, taking action is going to be the most important thing. It's not about looking at this list and going, okay, joint ventures, if that's going to work for you, that might be the greatest strategy. Even syndicates, that might work for some people, but it doesn't work for me. And this is my tier list. So look at these strategies, look at ways you can stack them for different properties and fast track your property investing journey. If you want help buying a property here in Southeast Queensland, then head over to purposeproperty.com.au. You can sit down with myself, we can have a chat, talk about your situation, break down your financials, look at helping you secure a property, whether it's your own home or whether it's an investment property here in the Southeast Queensland or Greater Brisbane market. We buy properties as low as $300K, up to several $1 million for owner-occupiers and investors at this point in time. So head over to purposeproperty.com.au to book in a free strategy session with myself. Now do it for your boss and drop a like on this video, subscribe to the channel down below. And if you want to see some overrated property investing topics, then click this video over here. I'll see you in the next one. Peace.